Coming up later in the France 24 debate with Donald Trump's tariffs going into effect since midnight. A trade war is indeed on, and it features the world's two biggest superpowers. Or for more, let's turn to business editor Yuka Royer.
Well, Francois, as you said, Donald Trump's new tariffs on almost all of the US's trading partners took effect on Wednesday, hitting China particularly hard with a 104% levy on all goods. Beijing hit back by increasing its previously announced 34% tariff to 84%. Washington says dozens of countries reached out to hash out a deal with the White House, saying it shows just how those countries need access to the US market much more than America relies on theirs. But China is standing firm. It says it wants to talk, but rather than capitulate to Washington's demands, it is ready to fight to the end. And it appears it's doing just that for now. Premier Li Qiang said the government had enough policy tools to offset the impact of a trade war, and Chinese leaders are reportedly meeting to discuss measures to prop up the economy. Now, for more on what this all-out trade war means from China's perspective, let's cross now to Xiaolin Chen, head of international at KraneShares, a China-focused investment firm in London. Thank you so much for joining us. Now, Xiaolin, China is standing firm, saying it will fight to the end. But do we see any end in sight? How far could this go? Will they end up slapping 300% tariffs on each other's goods?
I certainly hope not, but at this juncture, the number of the percentage of tariff become irrelevant. 104, 84 is the same deal. At the end of the day, you add another 50 or not, it doesn't become any matter anymore. The key message here is that both countries stand still to dealing with issues like such, which is very unideal for the whole world. It's not a US and China issue, I'm afraid, with the number one economy and number two economy in the whole world facing each other in this hard way. It doesn't solve the problem. At the end of the day, this will have immediate, obviously, the near-term pain for US. A lot of the importing goods from US is immediate household needs goods, such as, footwear, shoes, clothing, and daily houseware needs. Where in China, slightly on the higher end of technology, airplanes, energy, so on and so forth, they could probably, for the short term, to avoid, needing or importing of such product. But at the end of the day, China face also a challenge of where they're going to source this agricultural product, which they import a lot from the United States. At the end of the day, China has rebalanced its economy slightly away from exports driven. Exports used to be 39% of China's economy back in 2006. Today, the exports is somewhere around 20%, not as high as we all feared. So that gave the Chinese policymaker the room to say, you know what, we have a way to navigate this uncertainty.
So China rebalanced somewhat its economic model, but it is still a big exporter. It is the world's biggest exporter, and the US market is a big deal for China. It's exported $439 billion worth of goods to the US last year. Are manufacturers willing to shoulder some of the tariff burden by cutting profits, or have they diversified their markets away from the US enough not to rush to any unfavorable deals?
Okay, you're absolutely right. 438.6, 439 billion is not a small number. That is roughly, give or take, is 2.3% of China's GDP. China's GDP is around 18 trillion, 18.8 trillion. So overall, the nominal number is high percentage-wise. It's right around 2.3%. Still, China's largest manufacturer in the whole world, period, the end. Have they diversified enough away from US? The short answer is yes. They used to have a significant percentage of exports is facing in the United States. However, year over year since 2006, that China's exports partner has shifted away from developed markets as a whole to ASEAN, to frontier, to emerging market, to their One Belt, One Road partners. Today, US exports give or take around 12% of China's GDP altogether, or exports altogether. So all I'm saying is China is very prepared in navigating this uncertainty. Somehow this second term Trump's administration give them 4 years in preparing to say, what if he took office? So they have plenty toolkits ready to stimulate the economy domestically.
But that diversification by China was, in part at least, helped by this so-called China plus one supply chain strategies, where Chinese companies basically moved their manufacturing bases outside of the Chinese borders to countries like Vietnam and Indonesia. But now those countries are also hit hard with high tariffs. Now, how's that going to impact the Chinese economy?
I mean, directly, indirectly, China going to get a lot of impacts. There's more questions than answers at this juncture. Unfortunately, we don't have all the answers to all the questions, but that's a great one that they also have to face indirect, exposures or hit by this tax tariff that announced by both countries. We somehow. Unfortunately, I know investors don't like to hear this. Patience is the key. We got to see how this unfolds in front of us all together as one. Second, a lot of manufacturers move outside of China to Vietnam, such as that is the low value chain company that's exporting such as cheap textiles to other countries whatsoever. High tech machinery and also high tooling required skills are still sitting in China because the vast majority of the skilled worker in China, because the best logistics sit in China. At the end of the day, China really need to focus on domestic its own economy to support, domestic economy. They have 1.4 billion people. 870 million of them are claimed to be middle class. China has the one most complete supply chain as one single country. I'm not saying they should close the door, but they have a very, very long runway for them to deal with. One, they can deal with a temporary shock as such and continue focus on growing its economy as one. Second, I somehow think the infrastructure China has, the skills of the worker China has, and also the geopolitical position they have is very, very difficult to replace overnight. Even the manufacturing return to US, we know that manufacturers don't plan in a 1 year or even short period like this, weeks and months, to reposition in their manufacturing line. It does take years, if not 5 to 10 years to position. So I somehow feel like both sides should calm down and come to a table, negotiate like professionals.
No, it does come at a slightly difficult time for China as well. It's dealing with its own problems economically at home, with the housing crisis and the real estate sector crisis, and also weak weak personal consumption. So does China really have the necessary tools to address this? You mentioned, in the short term, it can deal with it, but how about, what if this continues for a long time?
Very good question again. China has faced a consolidation of real estate for 2, if not 3 years now. I am a long-term bear on real estate, but after seeing how it has consolidated over 3 years' time, I become a bit of like neutral to slightly bullish. Given the current level, I have to say the Chinese policymaker has activated the put policy to allow real estate sector to settle from here. It won't go back to the golden time, but it will not continue to fall from here. You will see stabilizing, uptaking. You see there's many index tracks the performance of the price of different cities, housing price in China. You start to see stabilizing from here and uptake from here, and also the sales start to take up. Obviously, that's one. The issue is settling down, if not slightly self-resolving on its own by now. That's one issue. Second, Chinese household bank deposit household is near the historical high level, Yuka. It's nearly 30, if not more than 30 trillions in the bank reserve. My take always has been China's issue is never a liquidity issue. They are rich in liquidity. It's a sentiment issue. It's how you feel if you're going to get a better job, better income. At this juncture, with almost 9 quarters of the Chinese policymaker, since Q1 2023, they have been doing easing, cutting interest rates, reduce the mortgage rates, allowing the credits to become cheaper. 9 quarters of efforts, quarter over quarter, to make macro environment to stay very accommodative. This is the time they show more bargains, and they do have very supportive macro policy. One. Second, they have a tool multiple tools. They haven't been even used yet, not even talk about exhausted. Special purpose bond, ultra long dated bonds, and they have a highest, if not FX reserve on balance sheets. There's a lot of things they can do. One, supporting money for the system to continue to go. Second, give very accommodative policy to the corporates, to the household, for them to feel the confidence, continue support. The other thing, don't forget, it's a nation that feel very proud as one nation united together. This kind of challenge somehow will put the nation more, staying more together and face the tough external challenge even more united than them ever have achieved. So I somehow feel like this is probably time to show how resilient the economy is in China.
Yeah, it is indeed time to show how resilient China's economy is in the face of all that is happening. Well, Xiaolin Chen, Head of International at KraneShares, thank you so much.
Thank you. Merci.
And that's all I have time for this bulletin.
All right, we'll be getting the closing word on what's been a seesaw day for world markets on all this, and talking about how China reacts to Donald Trump in the France 24 debate. Many thanks for that, Yuka Royer.